All right. So here's our agenda. We're going to kick it off with some introductions to myself and our CFO, Mike Dansby, and then also Kinsero, who we are and what we do. Then we'll talk through a couple of the ways that companies can become audit and due diligence ready, and also why that matters, why CEOs, CFOs, investors should really care about this. We'll also get into some testimonials. So we'll walk through a couple of different client case studies that we have of companies that have been audit ready, due diligence ready, and the outcomes of transactions in their audits. And then finally, we'll get into some Q&A. So if you have any questions as we're going through this, please don't hesitate to go ahead and put them into the chat. We'll definitely have some time to answer those at the end. All right. So I've already introduced myself, a little bit more about me and my role. I oversee our private equity and venture capital investor relationships here at Kinsero. I've been with the business since 2020 and have been an operator at fintech and financial services companies since 2016. Also, I'm joined by our COO and CFO, Mike Dansby. Mike's been with the company now since August of 2016. Mike, rather than the audience hearing it from me, could you share a little bit more about yourself and your background prior to joining Kinsero?
Yeah, sure, Tony. Thanks. And coming to everyone today from the Great White North in Ottawa, Canada. We're visiting with our team that's up here this week and are looking at the first snow of the season outside for those of you in warmer and less snowier climes. Winter's coming. Great to be here. As Tony mentioned, I'm the Chief Operating Officer and CFO for Kinsero. Over my time here, I've been, both in delivery and operational, as well as support roles with CFO. Prior to coming, I've been a CFO in several different companies, mostly venture capital backed. Taken through many through exits and so forth. I also spent several years with Alvarez and Marsal and their business consulting group, serving private equity backed companies.
Awesome, Mike. Well, thank you for joining us, especially during your travels to the Great North. Before we get into the presentation here, would love to share a little bit of background on Kinsero with everybody. Some quick background. The business was founded in 2006 by our CEO, Scott Tynes, and President Bill Klein. And the original intention of Kinsero was to create an alternative to actually building a fully in-house finance and accounting function. So today, if you look at us, we're about 1,500 employees worldwide, about 250 clients, and we support all of them with our finance as a service, or FAS solution. And finance as a service is actually one of those things that can help companies to get into an audit and due diligence ready state. Here at Kinsero, we really do two things mainly. So one is finance transformation. So making sure that companies are in that optimal state, right? Getting them to that audit ready, diligence ready, exit ready state. And then the other piece is helping companies with ongoing managed support within finance and accounting. And we really cover the full finance stack. It's everything from people and human capital to process and all the way to systems and systems optimization. And we've really developed a playbook approach, and we've executed on it hundreds of times, specifically with private equity and venture-backed businesses, and also their investment managers. And we do everything from implementing cloud-based finance and accounting systems to defining and documenting policies and procedures and some of the best practices that we've built up over the past 15 or so years, and then also providing that scalable back office team. And you can look at that as everything from just your month-end close staff and a controller all the way up to fractional CFO, on-demand services, and then also things like annual audit support. So coming in with that as needed, and more on this as we go through the presentation. If you have any questions, again, don't hesitate to put them into the chat, or feel free to reach out to us directly. We definitely want to hear from you. For now, though, I'll turn things back over to Mike, and we can get into some of the reasons why it matters that companies get audit and due diligence ready.
Thanks, Tony. Great introduction. both with Consero and my times prior. I mean, I started off as an auditor in the Big Eight once upon a time. So certainly I've been an auditor, and then I've been on the other side of it as a controller and CFO, as well as a consultant. So I've seen this from many points of view, and what I've found is that a lot of times finance and accounting leaders and maybe even some CEOs just look at audits as a necessary evil, and something they'd rather not think about, and then just take care of it when they get there. um, Again, if you're investor backed, at some point you're going to go through a liquidity event, we hope. But what comes with that is due diligence. And there's never a bad time to be preparing yourself for due diligence. But a lot of times people just put it off and say, well, we'll deal with that when it comes, and put it off in the future. And in both cases, what happens is, when you defer your preparation, all of a sudden it becomes a major crunch. It's a it's a big tax on your time, on your staff's time, and you don't always look the best. And I think our finance and accounting leaders here, you'll miss an opportunity to shine. They can be there, they can be ready, with a little bit of malice of forethought, they can, step up to, these due diligence opportunities and get through that quickly, not hold the deal up, and really look great, for their board, their investors, and their other executives. Let's think about some impacts when you don't plan, for these events. Like I said, audits by nature are generally an additional burden, but if you plan it well, you can reduce it. Why? You know, I'll just tell you this, being a former auditor, a well-planned audit, and auditors that are treated well, they get nice, clean audit packages, on time. Auditors just aren't going to probe as hard. They're not going to make your job hard because they're there. Uh, I can remember, I could think of two clients I was on as a staff auditor, and one of them just wasn't prepared, didn't like having us there, fought every request. I went after that person hard. And I made their life miserable. It was a confrontational, thing all the time, and I saw that elsewhere, and that wasn't a fun thing for anybody. By contrast, we had another client, as it turns out, that controller was a former Andersen auditor. She knew the game. We walked in there. She took us to lunch every day. The audit packages were prepared. The selections were pulled. It was an easy deal with no overtime. We got through that audit, under the fee, under the time. So we weren't a burden there. We weren't a pain. We all liked being there, and it was a better relationship for everybody. Furthermore, if you have a clean audit, you won't have a big long set of comments from your auditors. Everything comes with a report on your internal controls, a report on the adjustments that had to be made. And those are all things that, as a CFO, you've got to step up in front of your board and in front of your management team and explain as to why you're deficient. That's just not a fun conversation when you have some material things happening. So I would just say, try to avoid that. There's other ways that poor planning on this can lead to disaster, that kind of increases costs here. One of them, I saw with a client in my consulting days, where they were struggling to get an audit done. It was understaffed. They were running up against their time limit, to get it done for loan compliance purposes. They had to bring our firm in. We're not, there wasn't Consero, it was Alvarez and Marsal. Those rates aren't cheap, and that cost them well into six figures, for us to get the audit done, work, on their side to support the audit and get it done in time to where, they didn't blow their covenants. So that's just one example.
Out of curiosity, Mike, do you have any other examples maybe of a company that you've seen fail audit? And if so,
Yeah.
were there any repercussions to them failing that audit?
Yeah. Yeah. So there was another one again from the consulting days, and this was a fairly large company, but it was still private equity backed. So you had two fairly large East Coast investors in this company. It was a carve out of a large, well-known industrial company, and by the time we got involved, they had 3 years of open audits. And with those 3 years of open audits came an audit letter from Price Waterhouse that had, what was the number? Something like 14 material weaknesses in it and 122 significant deficiencies. And for you non-finance and accounting people out there, that's a lot. I mean, just having one material weakness in a letter is not a good thing, much less 14. And so what was what was the impact of that? Well, again, they were spending a lot of money with Price Waterhouse just trying to navigate their way towards how do we get to a clean audit. Two, one of their investors wanted to exit. And so when they went through that process, not having a clean set of financials, by their estimation, took 25% off the valuation that they got for their portion, Tony. And so then they end up bringing us in. That was well into seven figures for us to fully remediate what was going on there before they had a good internal control environment. We'd cleared all the weaknesses and deficiencies, reorganized their accounting department and so forth. And it paid off. They were able to sell the whole thing a year and a half later at a far better multiple than what the partial sale had been done before. So having all that lined up, while it may not add value necessarily, Tony, if other things aren't there, if it's not in good shape, it will take away value and cost you money out of pocket on consultants and so forth. So from that end, again, just on the due diligence side, we all know time kills all deals. You need to be able to populate a data room on a moment's notice, because you never know when an external factor might kill the deal. Another client I was interim CFO on back in 2009, they were private equity backed. They had run revenue up in some unnatural ways, trying to get to a good solid valuation. They had a deal on the table. It was 3 days from closure, and Lehman Brothers, files for bankruptcy and dries up all the capital markets. They couldn't get their deal done. Deal didn't close. Again, had to bring in, a restructuring team 6 months later. Spend seven figures, on that to get it straight, and put off a liquidity event for at least 2, if not 3 years. Was how that worked. And I don't know whether anything was in that deal that might have held it up, but 3 days, 3 days is hard. You don't want to be, that guy that caused, if there was a 3-day delay in there, have that be on you, and something that can't get done. So, all in all, I think if you approach, sort of your daily, weekly, monthly processes, both in accounting as well as data management, and trying to be always audit ready, then, you'll be recognized as, as a dependable and capable leader, in all of this, and certainly, be there to, support whatever deal needs to happen, support the valuation that your company deserves, if it's a liquidity situation. So we can move forward to the next page. Okay, so like I said, with you all have investor-backed companies, an exit is someplace in your future. So start with the end in mind. What do you need to support a due diligence process? I mean, obviously, you need a set of financial controls and processes that will breed a clean audit. But that approach will also support due diligence. you also need to think about your document management, and this goes beyond just the financial controls. And so we'll talk about that more here in a second as we get through it. But all in all, if you're doing your audits on a timely basis, you're getting clean audits, it's good practice for going through due diligence. So, what do I do when I get into a CFO role? What I like to do is pull out just a standard due diligence checklist. And if you don't have one, your lawyer has one, or your banker has one. And I go and map our processes and our data management to that checklist and make sure that I've got those various things, at my fingertips at all time. Now, not all of those things are, within the CFO's purview, right? I mean, there's, product things and engineering things that you want to have, but take the opportunity to be a leader, and share those items with other members of your team so that, they're always ready. They're always ready as well. What I've found to be troublesome areas are really around employee document management, and then just your contracts management, whether it's your customers or your suppliers. And we'll talk in a second about how to save yourself time on those areas. We can go ahead and go to the next slide. The second piece here is build relationships. So, there's a lot of people that are involved here. I mean, obviously, you've got your auditor supports your audit. You don't need, bankers and attorneys for that necessarily, but your due diligence exercise is going to have, several people involved. When I think about the audit firms, maybe people have different opinions on this. I mean, I'm an alumni of a large audit firm. So obviously, like them, they're great breeding grounds. They support the big companies. I think for our audience here, the VC, private equity backed companies, honestly, go with the regional firms. The big firms are not going to be as responsive for you. They're not going to be as consultative. They may not be as prescriptive, but they're going to charge you big fees. And they may argue your policies more than some of the regional firms will, and not to your benefit, just to the benefit of their pocketbook. Again, in my opinion, I've seen some of this happen. But take advantage of the relationships. Just don't go to them when you're in the deal. For me, with my audit firms over time, always had that relationship with the partner. Looked for excuses to talk to them during the year. If I had some policy item come up, something new come up, I'd call them and talk to them about it, so they knew about it going into the audit. And if there was an approach we had to agree on, we agreed upon it there. Versus, now we're going through manager and partner reviews. This comes up, and we spend a week or two arguing what it is. We've already got that stuff settled out. Another trend that I'm seeing now that I didn't see a few years ago is, a lot of private equity firms, they want to come in and they want to do the quality of earnings analysis. I think what firms are starting to do now is to go do their own, prior to going out to market. That way you go and kind of suss out, what you think people might be looking for, and you've got the answers for them right away, so that you're not holding that up unnecessarily. You don't have any surprises or gotchas when you are going through that process. So I think, more so than the audits now, the firms are relying on those QOVs to really give them a sense for, the health of the business. And so, if you haven't thought about that at all, and I would say if you think you're within a year of going to market, go find somebody to do a QOV on your behalf. And yes, it's going to cost you some money to go and do it, but it'll be well worth it, because you'll surface where your analytical landmines are, what you're really not reporting on that maybe you should be reporting on. They'll help you with that. You'll be able to gather that data ahead of time. And then when the buyer does show up, you're there, you're ready. Again, you're not holding up the deal. Okay, let's go to the next slide. Okay, what does it mean to be audit ready? You know, certainly, having your documented processes, procedures, internal controls. I mean, it doesn't have to be to the nth degree, but have something you can hand to an auditor and that they can review. The biggest thing that I think people blow, especially if you haven't had a CFO in there, or if you have a CFO that's very sort of high level and finance and strategic oriented and so forth, is that maybe the accounts, the balance sheet accounts aren't reconciled on a monthly basis, and that may sound like pretty simple and basic, but we get a lot of clients coming to us at Concero and they're not reconciled. And that ends up costing money with us to go get those done, because we have a promise of being audit ready right from the start. So we've got to go get those done. But the thing is with those is they serve as the basis for most of your audit review schedules. And so to the extent that you keep those current throughout the year and then get into audit mode, it's not going to be a big deal to go through audit. And so as a CFO, I mean, I've got head controllers, have a controller now, is I expect the controllers to do that on a monthly basis, and I look at it quarterly. I may not look at all of them. I look at the most important ones, look at deferred revenue, look at cash, that sort of thing. Make sure that we don't have any landmines there that are going to be big gotchas, whether it's in audit or whether it's in due diligence. The next thing is stay up on your accounting standards. You don't have to be a GAAP geek, but know what's current. And you can do that either through the the AICPA websites, or just making sure that your audit partner, your accounting firm, is letting you know when new pronouncements are coming out. At Concero, we've got a technical accounting group that stays on top of that and circulates that to all of our finance leads, and so that's how we do it. But you'd be amazed at how many clients come to us, and the revenue recognition standard 606, which is new as of 2020, and here we are at the end of 2022, they haven't implemented it. And then we're having to go through a big exercise to implement it so that they can be GAAP compliant, support their bank loans and so forth, because you got to represent that they're GAAP compliant. It's a lot of work. And when people haven't done it, and just be aware, it can be very expensive depending on who you go to. We try to bake that in largely to our implementation fees, but some of the big firms, I've seen 6-figure numbers associated with trying to put a policy like that in place. On the data room side, I mentioned some of the employee things. Work with your HR team there, because what happens there is sometimes we're, especially as companies are starting and growing, get a little bit sloppy on the proprietary information agreements and the invention assignments, and not having the intellectual property assignments, and all of a sudden you don't have signed agreements. And that's one of the things that comes up in due diligence. Do you have any claims on your intellectual property, and have you protected yourself against employees that might have been working on them? And then they say, oh, I don't have it for these 5 people. Well, you got to go get it. Well, I don't know where they are. They left the company, and now you've got to go chase them down. And what does that do? That adds time to a deal. What happens when you add time to deals? You either decrease the value or you kill it. So stay on top of that right from the start. The other piece there, and this really falls on CFOs, in deal mode, especially if you're not big enough to have in-house counsel, is when you put together the purchase documents, you have something in there called exception schedules. And there's a lot of detail that goes into those, that relates to fixed asset detail, that relates to contracts, exceptions to contracts, and so forth. So if you've got those things spread all over the place, then that takes forever to try to pull together, and you're going to kill yourself. At the end, you're trying to get a deal wound up and you're trying to go track all this stuff down. It can be a pain. Whereas if you just stay on top of that proactively, you've got your documents structured and filed in a way that just supports this automatically. You really cut down the amount of work, at deal crunch time. And by the way, with that, we've seen clients come to us where it's like every contract's custom. And that's a pain for RevRec. It's a pain for going through contract due diligence. So I know it turns into a fight with sales as, hey, don't be the denier of sales, finance and legal. But to the extent that you can get to a relatively structured and standard contract and not deviate from it much, you're going to make your life a lot easier, both in audit and in due diligence. It's worth the argument. Is my belief. All right, let's next slide. Okay, so benefits of getting it right. I think we've kind of sprinkled that through the talk here. Audits and due diligence doesn't have to result in excessive overtime, working late, working weekends. I think you can really impress your advisors, your owners, your teammates, prospective buyers by having this organized ahead of time and just having it be a matter of course activity. Build it into your day-to-day planning. Again, you're all building towards being bought by somebody else. It's a known process to go through. Audits are a good practice for it, but in the end, the due diligence exercise, that's the main event. Plan for it. Be ready for it. Start trying to be ready for it from day one. As I mentioned, Concero's solution, and as it came from industry, and now I've been doing it from this side for 6.5 years, and I'm always impressed with how well we show both in audit and due diligence. And Tony's going to go through some examples here in a minute of some of the things that our clients have done and said about us. But I don't think I've ever heard anybody say anything bad about us in an audit exercise or due diligence exercise, and that's not sales. That's I think just the way it's worked, and it's the way that we structure our service. Like I said, we promise audit ready financials each month. I think whether you're with us or not, if you think of it in those terms, you'll be well prepared.
That's exactly right, Mike. And here on the next slide, we have a couple of testimonials which can illustrate the way that Concero can help both through audit and through due diligence. So this first quote we have from David Westbrook. So he's the CFO of Robert Stevens, which is an investment management firm who we support annually with audit. And I'll just kind of read this verbatim, right? Concero helps significantly with getting audits done timely and providing the reports auditors need. I can actually go away on winter vacations, which was something I was never able to do previously. I know Concero has things under control with the auditors, and I don't need to worry. So the bottom line here is that once we really get, as Mike has been talking about, the Concero team, the infrastructure in place, it's pretty easy to get through an audit or a due diligence process with our clients. On day one, once companies leave the Concero onboarding, they are GAAP compliant, ASC 606 compliant, audit ready, exit ready, diligence ready, and that's on day one. And another key benefit is all of the documentation that we're putting together behind the scenes, all of the audit trails. So when you do have that auditor who has those questions, we have everything ready to go, and you're not having to go back months later and try to recreate documentation that should have been just done more proactively. So it's more of a proactive approach with Concero and finance as a service versus that reactive approach that you see a lot of companies making those mistakes. This other piece here was with Steve Isolm. So he's the former CFO of Flywheel. So it's an internet software business who we actually helped to exit to a strategic buyer, WP Engine. So in this case, I won't read through this one in total, but more or less, Steve just really speaks to how comfortable we made everybody during that transaction process. And we've helped hundreds of clients in our, client base that are existing clients, or maybe they've exited to strategics, right? Through this exact exit, process. It could be the financial buyer, strategic buyer, public markets. One client that comes to mind just speaking about exits to public markets is BigCommerce. So that was a venture-backed business who we've been supporting since they were just Series A backed as a startup. Today, publicly traded business on the NASDAQ exchange. We still continue to work with them, but they're north of 200 million in annual revenue. So we've helped them with multiple rounds of funding since that Series A when we first started working with them. And then also they had all the necessary documentation that they needed to pass muster of the SEC and financial regulators to ultimately go into the public markets. And as a follow-up to everybody who's been on the call, and also just to those who have RSVP'd, we're going to send a recording of today's presentation and then another link to the discussion with the CFO, Robert Stevens, David Westbrook. We had a conversation with him a few weeks back, and it just provides a little bit more color and detail into how Concero supported him with his audit. So with that, I think we can move on to some of the questions that have come in via the chat. And this one, it's actually a nice segue. I'll direct it towards Mike. So this is just kind of more from a tactical standpoint, Mike. Folks on the call were just interested in what are some of the things that Concero does, to support clients with audits or a transaction process. And I think what they're getting at here is, right, is it maybe kind of that core team that they're working with day to day? Is it another team that we bring in? They're just kind of interested in the tactics there.
Yeah, sure, Tony. And obviously it all kind of depends on, what level of involvement, the client's comfortable with, how much they want to be involved in the audit or not. But quite often, the CFOs we work with, sometimes the more hands off I can be on that, the better. And so, we do just support it, with the team that works month in and month out. It's the same team that works to support the audit. But, what we'll do is in the fall, obviously we'll want to go and make sure that our recs are all up to snuff and do a review there, as I mentioned. But then we'll make sure that our clients set up a planning meeting with their auditor, and so we'll get on with with our VPF and with our controller, client representative, auditor, talk through the audit plan, the dates, get an agreement as to who's going to provide what. Obviously, there's some things, like board minutes and stuff like that need to come from the client. But most of the financial backup, we can provide and support. And so we'll go close out the year, get into the audit. Our controller that's assigned to the engagement will do most of the data management as far as pulling the PBC requests, uploading those directly into the portal. And then as the auditors come in and start to do their work, when they have questions on those schedules, that generally ask them directly of our controller or our VPF. And quite often our controller. And then they'll have their selections. Again, they'll send them directly to us. We'll upload them into their portal. And a lot of times our clients don't need to get involved until we're going through the audit wrap up, and whether or not there's any adjustments that need to be discussed, or auditor observations. That's when they're getting involved. And we have all the planning in place. We get that all done and on time. It's we generally end up with clean audits, and the CFOs can go to their boards and report accordingly. But we really take most of the work out of it for our client folks.
Awesome. One other question that came in related to that, and we might have time for one more. So if anybody does have any more questions, feel free to enter them into the chat now. This one is directed more towards software. So Mike, is there any software that we leverage at Kinsero to help clients with audit?
Yeah, Tony. I mean, obviously, it's you want to have a good GL and well organized chart of accounts, and so a lot of systems serve well for that. We know some of the shortcomings with QuickBooks because you can't do hard closes on them, so you're going to want to preferably in something that's a level up from that. We use Intact, and that's a good mid-level sort of cloud-based software. In addition to that, we also use something called Blackline. I mentioned the account recs before, Tony, and that's what we use to document our account reconciliations. And it has an automatic integration with Intact, so it kind of makes the transfer of information a lot simpler, and it allows you to have a very easy to follow standard format for justifying your balance sheet balances. So that's what we like to use. Honestly, it's not inexpensive. So, if you're a standalone company, it doesn't come, without cost, but, we're able to leverage that across our platform, and our clients benefit from that leverage.
Thanks for that, Mike. All right, well, it doesn't look like there are any more questions here, but again, as I mentioned, folks, feel free to reach out after the webinar, right? Mike and I would love to hear from you. And just on behalf of everyone here at Kinsero, thank you all for taking the time to attend today.